Everyone dreams of turning their hard-earned money into real wealth, but how do you actually do it? So do you invest in individual stocks, betting on the next big thing, or play it safer with index funds that have built fortunes for generations? In this video, I'm breaking down the battle between stocks and index funds, and most importantly, I'll show you exactly what to look for in a company if you decide to pick stocks yourself. This isn't just about theory, it's about what works, what doesn't, and how to grow your portfolio the smart way. Now, before we jump into the deep end, let's talk about why this debate even matters. We live in a world where financial literacy is no longer optional, it's necessary for survival. Inflation eats away at our savings if it's just sitting in a bank account, and Social Security isn't a guaranteed safety net. So, investing in the stock market isn't just a good idea, it's crucial for achieving financial independence. But how you choose to invest, whether in stocks, index funds, or a mix of both, could mean the difference between retiring comfortably or working far longer than you ever planned. Let's start with a quick overview. When we talk about index funds, we're talking about investments that aim to replicate the performance of a market index, like the S&P 500. These funds are incredibly popular because they provide instant diversification at a low cost. Think of them as a one-stop shop for spreading your investment dollars across hundreds or even thousands of companies. If you invest in an S&P 500 index fund, which I personally do, called VOO, which is an ETF in my brokerage, you're essentially buying a tiny piece of 500 of the largest, most influential companies in the United States. That means you get the benefit of the entire market's growth over time. On the flip side, investing in individual stocks is where things get interesting and risky. Here, you're handpicking companies you believe will outperform the market. This strategy has made people like Warren Buffett and Peter Lynch into legends, but it's also caused many investors to lose a lot of money. Picking individual stocks requires a deep understanding of a company's financials, its industry, and even broader economic trends. You might be wondering, why not just invest in index funds and call it a day? It's a fair question, honestly. Index funds have an impressive track record, and many financial experts argue they're the best choice for the average investor. Historically, the S&P 500 has delivered an average annual return of around 7 to 8% after inflation. Over the long run, that kind of growth is hard to beat, and for those who don't have the time or expertise to analyze individual companies, index funds are a reliable, hands-off way to build wealth. You set it, forget it, and let compound interest work do its magic. But here's the catch. While index funds are designed to match the market, they'll never beat it. If your goal is to achieve truly extraordinary returns or to focus on a specific sector like tech or healthcare, that's where individual stocks come in. Remember, every time you buy a stock, you're placing a bet. You're betting that the company you're investing in will outperform not only its competitors, but also the market as a whole. And yes, there are companies that have done this spectacularly. Just think about Apple, Amazon, or Tesla. Early investors in those companies have seen their money multiply many times over, but hindsight is 2020. The challenge lies in identifying the next big winners before they skyrocket. What's the real drawback of stock picking? Simply put, it's hard. Even professional investors, people who spend every waking moment analyzing markets and companies, often underperform a simple index fund over time. Markets are incredibly efficient, and the information you're using to make investment decisions is available to millions of other people. Beating the market isn't impossible, but it takes a rare combination of skill, research, and a bit of luck. Stock picking is not for a faint of heart. Now, let's talk about risk tolerance. This is where things get personal. If the idea of seeing your portfolio drop by 20% or more in a market downturn makes you queasy, index funds might be a better fit. They spread out risk by investing in a broad range of companies, so the collapse of one or two doesn't significantly impact your investment. On the other hand, if you can stomach volatility and have the confidence and research to back your choices, individual stocks could offer kind of returns that index funds can't. Here's a reality check. You'll hear stories of investors who made a killing on a single stock, but You'll hear far fewer stories about the ones who lost everything chasing the next big thing. Survivorship bias is real. That's why I always stress that if you're considering stock picking, do your homework. Treat it like a business decision because that's exactly what it is. When you buy a stock, you're becoming a part owner of a company, and you need to think like a business owner. Finally, let's discuss why diversification is key. Even if you decide to invest in individual stocks, spreading out your investments across various industries can reduce risk. But with index funds, you get built-in diversification. You don't have to worry as much about a single company's earnings report or a stupid CEO scandal tanking your investment. Instead, you're betting on the overall growth of the economy, which historically has been a solid bet. To wrap up this chapter, think of the stocks versus index funds debate like choosing between two paths to wealth. Index funds offer a smooth, steady ride, but they lack the thrill and potential high rewards of individual stocks. On the other hand, stock picking is exciting and can be incredibly rewarding if you get it right. But it's also a path fraught with danger. As we move forward in this video, we'll dive deeper into what to look for if you choose to invest in individual companies. So stick around and make sure you're equipped with all the tools you need to make the best decision for your financial future. We have plenty more coming, and we need to talk about what are index funds. You're in the right place. By the end of this chapter, you'll know exactly what index funds are, how they work, and why they might just be the perfect investment for you, or at the very least, a crucial part of your overall strategy. So, what exactly is an index fund? At its core, an index fund is a type of investment fund that aims to replicate the performance of a specific market index, such as the S&P 500, the Nasdaq, or the Dow Jones Industrial Average. When you invest in an index fund, you're essentially buying into a basket of stocks that mirrors the performance of that index. The most popular example is an S&P 500 index fund, which gives you a tiny slice of the 500 biggest, most influential companies in the United States. We're talking about giants like Apple, Microsoft, Amazon, Google, companies that have a massive impact on the market. The genius of index funds lies in the discipline effectiveness. You don't have to spend hours analyzing financial statements or keeping up with every piece of breaking news about individual companies. Instead, you can invest broadly in the market and benefit from its overall growth over time. Historically, the stock market has gone up in the long run. Yes, there are ups and downs, sometimes terrifying drops. But if you zoom out and look at a 10, 20, or 30-year chart, the trend is overwhelmingly positive. That's the magic of long-term investing. Now, let's talk about why index funds have gained so much popularity. It all comes down to three main factors: diversification, cost, and performance. Let's break these down one by one. First up, diversification. When you invest in an index fund, you're not putting all your eggs in one basket. Instead, you're spreading your money across hundreds or even thousands of companies. This built-in diversification is crucial because it reduces the risk of a single company or even a few companies dragging down your entire portfolio. So if you just invest in just one stock, your financial future is tied directly to the fortunes of that one company. If it goes under, so does your investment. But with an index fund, even if a few companies underperform, the strong performance of the others can balance things out. It's a simple yet highly effective way to mitigate risk. The second factor is cost. One of the biggest advantages of index funds is their low expense ratios. Expense ratios are the fees you pay to the fund manager for managing your investment. With actively managed funds, you're paying for a team of experts who try to beat the market by picking the best stocks. The problem? They rarely do. In fact, studies have shown that most actively managed funds underperform the market over the long term. Index funds, on the other hand, are passively managed. They simply track the index, which means there's no need for a highly paid team of analysis. As a result, the fees are much lower, often just 0.03% to 0.2% per year. That might not sound like a big deal, but over decades, those savings add up to tens of thousands of dollars. And that brings us to the third factor, performance. You might think that with all the resources and expertise behind actively managed funds, they're constantly outperform the market, right? The data says otherwise. According to the S&P Dow Jones indices, about 80 to 90% of the actively managed funds fail to beat the market over a 10 to 15 year period. In other words, if you have just invested in a simple index fund, you would have done better than most professional money managers. That's a humbling statistic, and it's one of the reasons why legendary investors like Warren Buffett recommend index funds for the average person. In fact, Buffett himself has said that most people are better off putting their money into a low-cost S&P 500 index fund and letting it grow over time. Let's address an important question. Who should invest in index funds? Is it right for you? The short answer is almost everyone. Even I invest in index funds alongside my individual stocks. If you're someone who doesn't have the time, interest, or expertise to research individual stocks, that's most of us, index funds are a fantastic option. They offer a stress-free way to participate in the market's growth without having to worry about making costly mistakes. And even if you are an expertise investor, index funds can still play a vital role in your portfolio by providing stability and diversification. Now you might be wondering, what are the downsides of index funds? While they're incredibly effective for most investors, they're not perfect. The biggest downside is that they guarantee you'll never outperform the market. If you're an ambitious investor who dreams of beating the market, index funds definitely won't get you there. Index funds, they're designed to give you average market returns, and while that's nothing to scoff at, it's not going to make you the next Warren Buffett. Additionally, index funds can include underperforming companies because they trace the entire index, not just the winners. If a company is part of the index, you own it, even if it's struggling. But for most investors, these downsides are minor compared to the benefits. Another point to consider is market timing. One of the biggest mistakes new investors make is trying to time the market, buying when they think prices are low and selling when they think prices are high. But here's the thing, timing the market is incredibly difficult, even for seasoned professionals. The beauty of index funds is that they make market timing irrelevant. Instead, you can use a strategy called dollar cost averaging. This means investing a fixed amount of money at regular intervals regardless of the market's ups and downs. Sometimes you'll buy when prices are high, and sometimes you'll buy when prices are low. But over time, you'll average out your costs and minimize the impact of market volatility. It's a disciplined approach that takes the guesswork and the stress out of investing. Because index funds are passively managed, they don't buy and sell stocks as frequently as actively managed funds. This results in fewer taxable events, making index funds more tax efficient. If you're investing in a taxable account, this can save you a significant amount of money and capital gain taxes over the years. If you're investing through a tax-managed account like a 401k or an IRA, index funds are still a great choice because their low cost and consistent performance helps your money grow faster. Now, let's get a bit more practical. If you're considering investing in an index fund, what should you look for? The first thing is the expense ratio, and this is honestly really important. As we mentioned earlier, lower is better. An expense ratio of 0.10% or less is ideal. Next, look at the fund's tracking error, which is a measure of how closely the fund follows its index. The smaller the tracking error, the better. Finally, consider the diversification of the index fund. Some funds, like an S&P 500 index fund, gives you exposure to large U.S. companies. Others, like Total Stock Market Index Fund, include small and mid-sized companies as well. There are also international index funds that give you exposure to global markets. Depending on your goals, you might want to invest in a mix of these to maximize diversification. In summary, index funds are a powerful tool for building wealth over the long term. They offer a simple, cost-effective way to invest in the stock market without the stress and complexity of picking individual stocks. While they may not make you rich overnight, they're a proven strategy for growing your money steadily and reliably. And that's something we could all use a little more in today's uncertain world. In the next chapter, we'll dive into the case for individual stocks and explore what to look for in a company if you do decide to go that route. We'll cover the metrics, the financials, and the qualities that set great companies apart from the rest. Trust me. Alright, now that we've covered the power of index funds, let's get into the more exciting yet challenging world of investing in individual stocks. This is where the potential for extraordinary returns lives, but it's also where you could find yourself facing significant risk. Investing in individual stocks means you're no longer riding the market's overall wave. Instead, you're placing specific bets on companies you believe will outperform. This can be incredibly rewarding. Just look at companies like Apple, Amazon, Tesla. Investors who got in early and stayed the course have seen their money grow exponentially. But before you rush to pick stocks, let's be clear. Identifying the next Apple or Amazon isn't easy. It isn't impossible, and you can definitely beat the market with just a little due diligence and choose compounders. There's a reason most people don't beat the market consistently, and it starts with the complexity of choosing winning compounding companies. Why might you want to invest in individual stocks? The answer boils down to control and potential returns. When you buy an individual stock, you're not just investing in a company, you're becoming a partial owner. That comes with specific rights, like voting on shareholder matters, but more importantly, it gives you the potential to earn returns that beat the market. If you're willing to do homework and have a knack for analyzing businesses, individual stock investing can be incredibly lucrative. Unlike index funds, which will always deliver average market returns, individual stocks give you the chance to achieve above average gains. The catch? You have to put in just a little bit of work and understand the risk and be prepared to manage your emotions when things don't go as planned. Let's talk about what makes individual stocks so appealing. One of the main draws is the opportunity to invest in companies you believe in. Companies you think are revolutionizing their industries or have a clear competitive advantage. For instance, if you're passionate about clean energy, you might be interested in companies like Tesla or NextEra Energy. If you believe in the future of artificial intelligence, you might look into Nvidia or Microsoft. Investing in individual stocks allows you to align your investments with your interests and convictions. Plus, there's something undeniably satisfying about seeing a company you've researched and invested in thrive. Individual stock investing comes with serious risk. For every Amazon success story, there are dozens of companies that never make it. Businesses fail, industries change, and unexpected events like economic downturns or regulatory shifts can derail even the most promising companies. If you're going to invest in individual stocks, you need to be comfortable with the possibility of losing money. The market is unpredictable, and even the best research can't guarantee success. That's why it's crucial to diversify your holdings and never put all your eggs in one basket. Now, let's get into the core of stock analysis. If you want to pick stocks like a pro, there are several things you need to look at. The first and most fundamental area is a company's financial health. This means diving into its financial statements, the income statement, the balance sheet, and cash flow statement. If this sounds intimidating, don't worry. We'll break it down into manageable pieces. Start with the income statement, which shows the company's revenue, expenses, and profit over a specific period. The top line is revenue, how much money the company made from selling its products or services. The bottom line is net income, what's left after all expenses are paid. Ideally, you want to see consistent revenue and profit growth over time. Not all revenue growth is created equal. Some companies boost their sales by slashing prices or taking on unsustainable amounts of debt. That's why it's essential to look at profit margins, which tells you how efficiently a company is turning sales into actual profits. Next, examine the balance sheet. This is where you'll see what the company owns, aka its assets, and what it owes, its liabilities. A healthy balance sheet typically has more assets than liabilities and a manageable level of debt. One key metric to watch is the debt to equity ratio, which measures how much debt a company is using to finance its operations compared to its equity. A high debt to equity ratio can be a red flag, especially in economic downturns when cash flows might dry up. Another important metric is current ratio, which compares a company's current assets to its current liabilities. A ratio above 1 indicates that a company has enough assets to cover its short-term debts, which is a good sign of financial stability. Then, look at the cash flow statement, which shows how money flows in and out of the business. There are three main components: operating cash flow, investing cash flow, and financing cash flow. The most crucial part is operating cash flow because it shows whether the company's core business is generating cash. You want to see positive and growing operating cash flow, as this indicates that the company has the financial flexibility. If a company consistently has to borrow money or sell assets to stay afloat, that's a huge red flag. Once you've examined the financials, move on to the company's competitive advantage. In the investing world, this is often called an economic moat. An economic moat is what protects a company from its competitors. For example, Apple has a strong brand and an ecosystem of products that keep customers loyal. Amazon has a massive logistics network and an economic of scale that makes it hard for smaller competitors to match. Microsoft, they benefit from its dominance in enterprise software and cloud computing. When evaluating a company, ask yourself, what sets it apart from its competitors? Does it have a unique product, a strong brand, a large network, or some other advantage that gives it staying power? Companies with a durable competitive advantage are more likely to deliver consistent returns over the long term. Another critical factor is the company's management team. Even the best business models can fail if the people running the company aren't up for the task. When assessing management, look at their track record. Have they successfully grown the company in the past? Are they making smart decisions to position the company for a future growth? A good management team is transparent, communicates clearly with shareholders, and makes decisions that align with the long-term success of the company. Be wary of companies where management is overly focused on short-term results or engages in questionable practices like manipulating earnings. Beyond the company itself, you need to understand the industry and broader market trends. Even a well-run company can struggle if the industry it operates in is declining. For example, think about how streaming services disrupted traditional cable companies or how electric vehicles are changing the automotive industry. You want to invest in companies that are positioned to benefit from industry trends, not be left behind. Research industry reports, pay attention to emerging technologies, and consider macroeconomic factors that could impact the company's performance. If you believe in the long-term growth of an industry, investing in a strong company within that space can be a great way to capitalize on that growth. Market sentiment can sometimes overshadow a company's fundamentals. Stocks can be overvalued or undervalued based on the market's mood, and this is where timing and patience comes into play. Even if you found a fantastic company, buying at the wrong time can lead to short-term losses. That's why it's essential to have a long-term perspective and be prepared for volatility. Remember, the stock market can be irrational in the short run, but over time, fundamentals tend to prevail. The biggest mistake most investors make is letting emotions dictate their actions. Selling a stock out of fear when the market drops or buying into hype when prices are soaring can destroy your returns. That's why it's crucial to have a well thought out plan and stick to it. If you believe in a company's fundamentals and long-term growth prospects, hold on through the turbulence. If something fundamentally changes, like a major shift in the industry or the company's business model, then consider reevaluating your position. To wrap up, investing in individual stocks can be both exciting and rewarding, but it requires a lot of effort and discipline. You need to dig deep into financials, understand the company's competitive landscape, and be prepared for emotional swings. The potential for high returns is there, but it comes with a level of more risk and responsibility that index funds don't require. In the next chapter, we'll help you decide which option might be better for you based on your goals, risk tolerance, and investing style. I'll also break down some companies. Now that we've explored index funds and the potential benefits of investing in individual stocks, let's dive into how you should approach evaluating companies. When choosing which business to invest in, it's critical to look beyond the surface and really understand the fundamentals, competitive landscape, and long-term prospects. Let's break down the most important factors from some of the companies from my portfolio. I want to go over Amazon, Google, Microsoft, Salesforce, MasterCard, Apple, and Broadcom. First up, let's discuss business models. Each company in your portfolio operates within a different business landscape, and understanding how each company generates revenue is essential. Take Amazon for example. Amazon's business model is uniquely diversified. It isn't just an e-commerce giant like what most people think of it as. A large part of its revenue comes from Amazon Web Services, or AWS, its cloud computing arm, which has much higher margins than retail. When evaluating Amazon, you want to make sure AWS is continuing to grow and maintain a leading market share, as this division significantly drives profitability. If AWS growth starts to slow, it could impact the overall business financial health despite booming e-commerce sales, which is more higher volume, less margin. Next, consider revenue growth and the company's ability to expand into new markets. When assessing Google, you want to pay close attention to how effectively its non-advertising segments are growing. For example, as privacy changes and regulatory scrutiny puts pressure on its business, the success of Google Cloud becomes increasingly vital. Consistent revenue growth in these other areas can indicate that Google is successfully diversifying and future-proofing its business model. Now let's touch on market dominance and competitive moats. A company's moat is what makes it difficult for competitors to encroach on its market share. Microsoft is a fantastic example of a company with an incredibly strong moat. It has entrenched itself in both enterprise software with products like Office 365 and Azure, its cloud platform. Azure's rapid growth and Microsoft's established position in enterprise services means the company is a dominant force in cloud computing and productivity software. When evaluating Microsoft, look at metrics like Azure's growth rate and whether the company continues to innovate and defend its market position against rivals like Amazon, AWS, or Google's cloud business. Another important factor is recurring revenue and long-term contracts, which can make a company's financials more predictable. Salesforce is a classic example. Its subscription-based software for customer relationship management means it has a steady and reliable stream of income. When analyzing Salesforce, you want to check the company's ability to retain customers and grow its annual recurring revenue, or ARR. A strong ARR growth indicates that customers find value in Salesforce services and the business isn't reliant on one-time sales. Keep an eye on how effectively Salesforce integrates acquisitions like Slack, as this could drive future growth and enhance its platform. MasterCard operates a global payments network, which means it benefits from the overall growth of cashless transactions and the rise of digital payments. Key metrics to consider here include transaction volume growth and the company's international expansion efforts. That's why I choose to be invested in MasterCard instead of Visa, because Visa is more of a United States player while MasterCard's growing more internationally. MasterCard's strategic partnerships with fintech companies and banks around the world create a strong and resilient revenue stream. Watch for how well MasterCard adapts to emerging technologies like blockchain and how it defends itself against competitors like Visa and newer entrants in the digital payment space. When it comes to brand loyalty and ecosystem strength, Apple stands out. Apple's ecosystem, its hardware, software, and services has created a highly loyal customer base. It's not just about selling iPhones. Apple generates revenue from wearables, services like Apple Music, and the App Store. When evaluating Apple, look at the growth of its service segment, which is becoming an increasingly important part of the business. Apple's ability to innovate and retain customer loyalty, even in a highly competitive tech market, is crucial to its continued success. Broadcom brings a different angle with its focus on semiconductors and infrastructure software. In this case, it's important to consider how well the company's products are positioned in the tech supply chain. Broadcom is a major supplier for companies like Apple, but is also diversified into software. Assessing Broadcom means looking at how well it can balance its hardware and software businesses. Watch for indicators like new chip designs and software acquisitions that could strengthen its competitive position. Additionally, keep an eye on global trends in semiconductor demand and how trade tensions or supply chain disruptions could impact its operations. Management quality is another critical factor. It's often overlooked, but a strong management team can be the difference between a company that thrives and one that merely survives. For example, Microsoft CEO, he's done an excellent job transforming the company into a cloud powerhouse. Similarly, under Tim Cook's leadership, Apple has expanded services and maintained strong product innovation. When researching companies, pay attention to how management allocates capital, communicates with investors, and adapts to changes in the market. Are they making smart acquisitions? Are they transparent about challenges? A strong management team often signals a company that's well positioned for long-term growth. Finally, don't forget to assess the company's industry trends and how each company fits into them. Google, for example, is deeply affected by trends in digital advertising and artificial intelligence. Amazon is influenced by changes in consumer behavior. Microsoft and Broadcom are tied to the rapid growth of cloud computing and demand for semiconductors. Understanding these trends will help you see the bigger picture and decide whether the companies in your portfolio are positioned to capitalize on future opportunities. Now that we've covered the ins and outs of both individual stocks and index funds, it's time to answer a crucial question. Which investment approach is right for you? The answer depends on your goals, risk tolerance, and how much time and effort you're willing to dedicate to managing your investments. Let's start with the case for index funds. If your main goal is to grow your wealth steadily over the long term without spending hours researching individual companies, index funds are likely the better option. They provide instant diversification, lower fees, and a set it and forget it approach. With an index fund, you're betting on the market's overall upward trend rather than on the success of a single company. This makes index funds an excellent choice for beginner investors or those who prefer a hands-off strategy. Your returns will be tied to the performance of the broader market, which has historically provided solid long-term gains. Like I said earlier, about 7 to 8%. However, there are also good reasons to consider investing in individual stocks, especially if you're willing to put in just a little bit of effort into research and manage your portfolio. For example, if you have a strong understanding of the tech sector and believe in the long-term growth potential, investing gives you the chance to capture above-average returns. These companies have incredible growth potential and can significantly outperform the market if you choose them wisely. But remember, with the potential for higher returns comes higher risk. If you choose individual stocks, you need to be prepared for volatility and have the discipline to stick to your investment thesis even during market downturns or bear markets. It's also worth considering a hybrid approach, which is what I do personally. You can allocate a portion of your portfolio to index funds for diversification and stability while setting aside another portion for investing in individual stocks you're confident in. For instance, you could keep 7% of your investments in a broad market index fund like the S&P 500 and use the remaining 30% to invest in high conviction compounding stocks like Apple, Salesforce, or Broadcom. This way, you get the best of both worlds: the steady long-term gains of index funds and the excitement and potential high returns of investing in individual companies. Currently, I'm about at 50-50. Before making your decision, consider your risk tolerance. If the idea of seeing a single stock in your portfolio drop by 20% in a month makes you anxious, index funds might be the safer bet. On the other hand, if you're comfortable riding out market swings and can handle the stress of watching individual stock performance, you might be well suited for stock picking. Additionally, think about the time. Researching individual stocks requires a commitment to stay informed about companies' earnings, industry trends, and broader economic factors. Investing is a long-term game, and your success depends on sticking to a well-thought-out strategy. Whether you lean towards the simplicity of index funds or enjoy the hands-on approach of picking individual stocks, the key is to stay consistent. Focus on building a diverse portfolio. Do your research and have patience. True wealth builds over time. If you found value in this content, don't forget to like and subscribe. Let's keep learning and investing wisely. Thanks for being part of this journey, and I'll see you in the next one.